There is a moment in every major wealth shift, a quiet, almost invisible turning point, where those who are paying attention step forward, and those who are not get left behind, holding nothing but regret. We are living inside that moment right now with silver. And the painful irony is that most people won't realize it until it's already over. I want to walk you through something today that I genuinely believe will be looked back on as one of the most significant financial opportunities of a generation. Not because I'm trying to hype anything up, not because I want you to get excited and make a reckless decision, but because the evidence, when you line it all up, is absolutely stunning. And the window, as the title of this video tells you plainly, is closing. Let me start by asking you a question that I want you to sit with for a second. If you found out that a resource used in virtually every green energy technology, every electric vehicle, every smartphone, every solar panel, and every advanced weapon system on the planet was being consumed faster than it could be mined, and had been for multiple consecutive years, what would you expect to happen to the price of that resource? You'd expect it to go up dramatically, right? You'd expect a supply crunch. You'd expect panic buying. You'd expect a kind of explosive price movement that makes people very wealthy if they're in early and very frustrated if they're not. That is the story of silver, right now, today. Before we go any further, if you want the practical side of all of this, how to actually position yourself intelligently, I put together a free guide that breaks down the exact saving strategies that thousands of American retirees are using right now to protect their hard-earned wealth from what's unfolding in these markets. It's sitting right in the description below this video. Completely free, no catch. Check it out when you're done here. It'll complement everything I'm about to show you. Now, let's talk about what's actually happening, because the surface level story doesn't do it justice. The Silver Institute, which is the definitive global authority on silver market data, not some fringe newsletter or Reddit forum, published their most recent World Silver Survey, and the numbers inside of it should have been front page news. Mine supply came in at roughly 846 million ounces. On the surface, that sounds like a lot, and it is. But here's where it gets interesting. Total demand came in at over 1.1 billion ounces. Do the math on that. You've got a gap, a deficit, of somewhere in the range of 280 to 300 million ounces. That is not a rounding error. That is a structural, persistent, and accelerating imbalance between how much silver the world produces and how much the world consumes. And this isn't a one-year anomaly. This has been happening year after year. We are running a silver deficit that the mining industry simply cannot close. You cannot just flip a switch and open a new silver mine. It takes anywhere from 7 to 15 years to bring a new major silver mine into full production. The permitting alone can take a decade. So even if every mining company on the planet announced a massive new project tomorrow, the physical supply of silver flowing into the market would not materially change for the better part of a decade. Meanwhile, the demand side of this equation just keeps growing. Think about what's driving industrial consumption of silver right now. Solar energy. Every single solar panel manufactured, and we are talking about literally billions of panels being installed globally as the world races toward renewable energy targets, requires silver. The photovoltaic cells that convert sunlight to electricity use silver paste as a conductive material, and there is no credible substitute that performs as well. Silver's electrical conductivity is the highest of any element on the periodic table. It is irreplaceable in that application. And as governments from Washington to Brussels to Beijing pour trillions into green energy infrastructure, the solar industry alone is consuming silver at a rate that would have seemed unimaginable just a decade ago. Then there's electric vehicles. Every EV has multiple silver-intensive components. The battery management systems, the electrical contacts, the charging infrastructure, all of it uses silver. And we are just at the very beginning of the global EV transition. We are nowhere near peak EV adoption. As that transition accelerates over the coming years, silver demand from the automotive sector is going to climb in ways the broader market is not yet pricing in. And then there's defense and technology. Advanced radar systems, satellite components, high-frequency communication equipment, antimicrobial medical devices. Silver is embedded in the most critical technological infrastructure of the modern world. Governments don't publicly disclose how much strategic silver they're accumulating for military applications, but the people who track commodity flows and industrial end use know that demand from this sector is growing, quietly and relentlessly. So when I say the window to buy cheap silver is closing forever, I mean that the conditions that would allow silver to remain at anything close to current prices are disappearing. Not slowly, not gradually over the course of a decade, but now, with every solar panel installed, with every EV sold, with every ounce pulled out of the ground that feeds demand but doesn't replenish what's already been consumed. Now, I want to take you back in time for a moment, because history has a brutal way of making fools out of the people who ignored it. Cast your mind back to the 1970s. The United States had just abandoned the gold standard. Inflation was raging. The dollar was losing purchasing power at a rate that felt terrifying to ordinary Americans. And silver, which had been trading at a few dollars an ounce for years, suddenly became the asset that savvy investors gravitated toward as a store of value and an inflation hedge. The Hunt brothers, Nelson and William, two Texas oil billionaires, saw what was coming before almost anyone else did. They began accumulating silver. Not paper silver, not futures contracts, physical silver. Tens of millions of ounces. At its peak, the Hunt brothers controlled somewhere between a third and half of all the privately held silver in the world outside of government stockpiles. And what happened to the price? It went from a few dollars an ounce to nearly $50 an ounce in the span of just a few years. That's not a 10% gain. That's not even a double. That is a move that turned every $1,000 invested into tens of thousands of dollars of wealth. Now, the Hunt brothers ultimately became a cautionary tale about the dangers of excessive leverage and concentrated positions. The CFTC changed the rules mid-game. The price collapsed. They went bankrupt. That part of the story matters because it tells you something important about how powerful forces move to protect the status quo when they feel threatened by silver's rise. But here's the thing. Even after the collapse, even after everything fell apart for the Hunt brothers, a fundamental lesson stands. When the world woke up to the reality of silver's value, the price moved in a way that was absolutely stunning. Now fast forward to the financial crisis era. Somewhere around 2010 and 2011, silver began another extraordinary run. In the wake of the housing collapse, quantitative easing, record low interest rates, and genuine fear about the stability of the financial system, silver went on a run that took it from roughly $8 or $9 an ounce all the way to nearly $50 an ounce in about 2 years. Anyone who was paying attention and positioned themselves appropriately experienced one of the most lucrative periods of their financial lives. And then it pulled back, and the mainstream financial media declared silver finished. They called it a bubble. They called it a fad. They went back to talking about tech stocks and real estate and the latest Wall Street darlings. Here's what they missed, and what they're missing again right now. The fundamental supply and demand story for silver was not resolved in 2011. It was not resolved after the sell-off. It just went quiet for a while, accumulating pressure beneath the surface, like a geological fault line that hasn't moved in decades. The pressure doesn't go away. It builds. Until one day, it doesn't. What's different today, and this is the part that I think separates this moment from every previous silver cycle in history, is that we now have a demand driver that is permanent and structural in a way that has never existed before. Green energy is not a trend. It is not a government program that might get canceled. It is an irreversible technological and industrial transition that is baked into every major economy's infrastructure plans for the next 30 to 50 years. The demand for silver from this single sector alone is going to dwarf everything that came before it. There's another layer to this that doesn't get discussed enough, and it has to do with the paper silver market. When you buy silver through most conventional financial instruments, ETFs, futures contracts, certain bank products, you are not necessarily buying physical silver. You're buying a promise, a piece of paper that says you have a claim on silver. And here's the dirty secret of the commodities markets. There is dramatically more paper silver in existence than there is physical silver to back it up. The COMEX, the primary exchange where silver futures are traded, holds a fraction of the physical silver that would theoretically be needed if every paper silver holder tried to take delivery of their metal simultaneously. Think about what that means. It means the paper price of silver, the price you see flashing on your screen right now, may not fully reflect the true scarcity of the physical metal. The paper market suppresses the price to some degree by flooding the system with synthetic claims that have no physical silver behind them. This has been documented, studied, and argued about for decades by market observers who watch the positioning data coming out of the COMEX and the LBMA in London. But here's what happens when this divergence between paper and physical reaches a breaking point. When enough large buyers start demanding actual delivery, actual physical ounces in actual vaults, the paper price has to converge with physical reality. And given the supply deficit we've already talked about, that convergence would be violent. It would be sudden. And by the time it's happening on your newsfeed, the people who were positioned will already be wealthy, and everyone who waited will be chasing a market that has left them behind. And that brings me to something I think is critically important for people watching this video, particularly if you are at or near retirement age, and you have been thinking seriously about how to protect what you've spent your entire life building. We are living in an era of compounding instability. Geopolitical fractures that would have seemed impossible to most people just a decade ago are now openly discussed as normal. The de-dollarization movement, the organized effort by the BRICS nations and their growing list of allies to reduce dependence on the US dollar in global trade, is real, it is accelerating, and it has direct implications for every person whose wealth is denominated in dollars. When the dollar loses its monopoly on global trade, and the data suggests this process is already underway, the purchasing power of dollar-denominated assets erodes in ways that can be genuinely devastating to people who don't have hard asset protection. On top of that, the debt situation in Western economies is reaching levels that have historically preceded either massive inflation events or severe austerity. There is no easy exit from the debt trap that have historically preceded either massive inflation events or severe austerity. There is no easy exit from the debt trap that most major economies have constructed for themselves. Central banks around the world know this. Institutional investors know this. And increasingly, high net worth individuals and family offices are responding by allocating heavily to physical metals, precisely because metals cannot be printed, cannot be inflated away, and cannot be defaulted on. Which brings me to something I want to mention briefly, because I think it's genuinely important for the right person watching this. If you have a retirement account, an IRA, a 401k, something you've built over decades of working hard, you may have more options to protect yourself than you realize. There are structures that allow you to hold physical precious metals inside a tax-advantaged retirement account. A gold IRA, or a precious metals IRA more broadly, lets you convert a portion of your retirement savings into physical gold or silver that is stored in a secure, insured vault on your behalf. It's not a fringe strategy. It's not something exotic. Major financial institutions facilitate it. The IRS authorizes it. And right now, with the convergence of geopolitical instability, dollar devaluation pressure, record national debt, and the supply deficit story in silver that we've been talking about, it may be one of the most important steps a financially prudent person could take. If that's relevant to your situation, there's information in the description on how to learn more about this kind of protection. Now let me tell you something else about where we are right now that I find absolutely remarkable: the gold to silver ratio. For people who aren't familiar, this is simply the number of ounces of silver it would take to buy 1 ounce of gold. Historically, the Earth's crust contains roughly 8 to 9 ounces of silver for every 1 ounce of gold. For most of monetary history, the two metals traded at ratios that roughly reflected this geological reality. For centuries, the ratio was fixed by governments at around 15 or 16 to 1. Look at where the ratio sits today. It is dramatically elevated above the historical average. What that means in practical terms is that silver is historically cheap relative to gold right now. Not in absolute terms, silver has moved significantly from its lows, but relative to gold, it remains profoundly undervalued. Every time in modern history that the gold to silver ratio has been this elevated, it has eventually corrected. The correction doesn't always happen at once, but it always happens. And when it does, when silver closes the gap toward its historical average relative to gold, the percentage gains in silver dramatically outpace the percentage gains in gold. That's not a guarantee. No one can guarantee anything in markets. But when you look at the historical pattern, when you look at the current ratio, when you layer in the supply deficit, when you add the industrial demand acceleration, when you factor in the monetary pressures on fiat currencies globally, the picture that emerges is one of a market that is coiled for an extraordinary move. I've talked to people who look at silver at current prices and say, it's already moved a lot. Did I miss it? And I understand that instinct. When something has already had a significant run, it feels like the smart money has already positioned, and you're just buying someone else's profits. But let me reframe that question by asking you this. At what point in the development of the solar industry did you say it was too late to invest in solar? When did the EV transition become already over? These are structural shifts. They don't play out in a quarter or a year, they play out over decades. And the silver market is at the very beginning of a structural rebalancing that will take years to fully express itself. Here's another thing I want you to think about. The retail investor is almost entirely absent from this market right now in terms of conviction. Yes, silver ETFs have seen record inflows. Yes, physical demand has picked up. But the broad retail investing public is still overwhelmingly concentrated in equities, in tech stocks, in crypto. The average person on the street does not own a single ounce of physical silver. When that changes, and the historical pattern says it always eventually changes when inflation rises or markets wobble, the demand surge from retail alone will be extraordinary. Now think about what happens simultaneously. Institutional demand accelerating, industrial demand hitting records, retail demand awakening, physical supply constrained by years of underfunding in mining exploration and development, paper market mechanics potentially forcing a convergence between paper price and physical reality, and a monetary system under more strain than at any point in living memory. Every single one of those variables is pointing in the same direction, and they don't need to all fire at once. Even 2 or 3 of them converging creates conditions for a price move that fundamentally reshapes the wealth of people who are positioned versus people who are not. Here's what I also want you to understand about the timing of this window specifically. The mining industry is not blind to what's happening. The largest mining companies in the world have been watching the deficit data, and they are trying to respond. New projects are being explored, capital is being deployed. But, and this is the critical point, mine development timelines are long. The silver that will come from projects being scoped and permitted today will not hit the market for years, which means the supply-demand imbalance that currently exists is not going away in the near term. It is, if anything, likely to widen before it narrows. And there is one more dimension to this that I think deserves specific attention: the currency dimension. This isn't just a silver story. This is a story about what happens to real assets when confidence in paper currencies begins to erode. We have watched central banks around the world, not just in emerging markets, but in major developed economies, engage in levels of currency creation that have no historical precedent. The money supply has expanded at a rate that should, by every classical economic measure, produce significant price inflation. And we have seen exactly that. Inflation in housing, inflation in food, inflation in healthcare, inflation in the basic cost of living that has been absolutely brutal for people on fixed incomes. Hard assets, physical metals in particular, are one of the oldest and most battle-tested hedges against currency debasement in human history. There is a reason central banks hold gold as their reserve asset of last resort. There is a reason that every time a currency has failed in history, and currency failures had happened dozens of times in the last century alone, the people who came out the other side with preserved wealth were the ones who had positioned in real assets before the crisis, not during it. The time to buy fire insurance is before your house is burning, not while the flames are climbing the walls. Let me bring this home for you. I've covered a lot of ground here. The supply deficit numbers from the Silver Institute, the industrial demand drivers in green energy and defense, the historical precedents from the 1970s and the 1980s, the mechanics of the paper-silver market, the gold-to-silver ratio, the currency debasement narrative. All of these threads are pointing toward the same conclusion. Silver is not cheap because it lacks value. Silver is cheap because the broader market has not yet fully absorbed the scale of what is unfolding. And by the time the broader market does absorb it, by the time this story is on the front page of every financial publication, by the time your neighbor is talking about it at a barbecue, by the time CNBC is running breathless segments about the silver surge, it will be too late to position at these prices. The window is not closing over years. It is closing over months, maybe shorter. The most important financial decisions people make are rarely the complicated ones. They're usually the simple ones made at the right time. Recognizing value before the crowd does. Positioning in an asset that has fundamental structural tailwinds before those tailwinds become obvious to everyone. That's what I'm describing today. Not a trade, not a get-rich-quick scheme. A fundamental, fact-based case for why silver, right now, represents one of the most compelling wealth protection opportunities available to thoughtful investors who are paying attention. Now, if you've watched this far, I want to make sure you have something actionable to take away from this. In the description below this video, there is a free guide that walks through the specific strategies that thousands of American retirees are using right now to protect their wealth through physical metals. It's completely free. And for anyone who watches this entire video, and you've more than qualified if you're here at the end, there's an opportunity to get access to a free, exclusive, one-on-one educational web conference with one of our specialists. No obligation whatsoever, just a candid, personalized conversation about how all of this applies to your specific situation. This offer is specifically available to American retirees who have a minimum of $100,000 in any retirement account. If that's you, all you need to do is mention that you watched this full video when you reach out through the link in the description. The window is open right now. Whether it's still open when you come back to this video in 6 months, that's a question I can't answer for you. What I can tell you is that history does not give these moments back. Check the description, take the next step, and protect what you've worked so hard to build.